So the topic of tonight's are there still opportunities within the global resources sector? Why this topic? It was because recently, because of the war, the global resources, global equities had done very well. Global resources are very much referring to oil, energy, and certain commodities. And all these sectors and investment channel had done really well. If I can quote an example, global resources, year to date, it had performed 20-odd%. So that was a very good performance, given that we are still within Q1. So let me analyze for you for tonight, all right? Before I start, I just want to let you know I represent Manulife Investment Management. We are a global company. We operate in US, head office in Canada, and we have a large operations in Asia. We operate in more than 10 countries. In Malaysia, we manage more than 10 billion ringgit. We are the top 5 asset manager in equities and fixed income worldwide. All right, worldwide, we manage US 1 trillion asset under management. And in terms of Malaysians rating, our Manulife ratings in Malaysia, we are 1 notch higher than the sovereign rating. So this is who we are. We are more than 100 years old. And here we are sharing with you about our experience and our credentials. So now going into the market, heightened risk. Are you afraid of COVID? Are you threatened by the war? Or are you concerned about the inflation or interest rate? Before I start, I want to ask the friends tonight here, people online here, how many of you have the experience of going through a war? I mean, not necessarily in the war, but going into moments of war or periods of war. Let's say the Gulf War. Do you remember the Gulf War? Yes, no? Okay. No, pandemic didn't quite happen. Okay, somebody raised hand. All right, very good. Pandemic, something that's other than SARS, I think it was some time ago. All right. Inflation, it happened quite often, and inflation is quite bad for the economy because things are getting more expensive and you got to tighten your belt, you got to spend less because things are getting so much more expensive. And oil price is a typical indicator of inflation. And now the oil price, is hovering about 100 US per barrel, and that is, expensive. And, if you are in overseas, your oil and your petrol is not subsidized, it can be very expensive. And of course, interest rate. People has this thought of about interest rate. If it's high, it's not good for the economy because you got to pay a higher mortgage loan. You have to, you want to place your deposit in the fixed deposit or the time deposit because you get better rate of return. So all these things are what is happening now in the investment environment. However, we have all seen this before. We are quite immune to it by now. And let me explain to you one by one. All right. So if you speak about a pandemic, this one I have been talking about since year 2020. If you look at the table, be it the HIV, the SARS, the avian flu, the dengue, the MERS, the Ebola, Zika, you name it, normally it went into three phases. The first phase, people get a shock, people panic, people were worried. You know, the second phase, once people realize, you know, how is it contagious, or how do you prevent yourself against it, you accepted it. And point number three is, you know, life goes on, you know, things get normal, you know, and things get better. And what you see on the graph, you know, is a series of pandemic. However, it didn't kill the market. It didn't kill the humankind. What it has done for the capital market over the last 30 years or 40 years or so in this graph is pointing out that there are many V-shaped recovery, and the market continued to rally. The market struck off pandemic concern, and people went through three phases, and you know, the market performed. And likewise, in year 2020, we saw pandemic COVID-19, coronavirus, you know, attack the market, went down by 3 weeks, about 30% negative performance, but you know, it has a strong rebound, 30% upwards. And not only that, the market continued to rally a lot, especially certain sectors. So we have been quite immune to this. Next, you know, if we speak about the war, you know, let's look at this. This is the war impact. If we go all the way down, you know, this is the Pearl Harbor attack. The Pearl Harbor attack is the Second World War II. You know, that is quite serious. However, if you look at one of the most serious here, the one-day volatility or the one-day drawdown could be 3.8% negative returns. And next, maximum drawdown could be close to 20%. And from top to bottom, it may fetch 143 days, and the recovery may be as close as 10 months. So, you know, people are very worried about the war, but this is Pearl Harbor attack is quite significant. The one that we are facing right now, Russia and Ukraine, is something that we have experienced fairly recently. I wouldn't say it's the same scale, but Russia and Crimea in 2001-4, it didn't last very long, all right? And Russia annexed Crimea, and you know, it was done fairly soon. But if you look at the overall impact, yeah, the overall impact, let's look at this. In many instances here, the one-day drawdown can be alarming, and the total drawdown can be more than just the 1 day. However, the market always recover. All right, next, this is very interesting because it goes deeper into analysis. All right, so if you look at 1926 all the way to year 2013, all right, that is a good 80 years or so. If you look at the large cap stocks during this period, the return is 10%, the risk is about 19%. Small cap giving you a return of 11.6. The risk level, the volatility, the deviations, the Sharpe ratio, you name it, you know, the volatility could be 27%. And the long-term bonds, 5.6% return, the risk level at 8.4. So I'm going to stop here and start analyzing. All right, here, all right, return 10%, risk at 19%. But if you look at the average of every war, you know what happened is the return is more superior than the normal days. Let's look at this. All wars at 11.4%, and the risk level, you know, adjusted downwards. I will explain to you why. This is phenomena, because during even the World War II, when you look at the return of the large cap, it is more superior than the normal days for 10% return. Here is 16.9% return. And the risk level lowered down, all right, lowered down. Korean War return and the risk likewise fairly similar. Vietnam War may be a slight exceptions, but you know, it's still lower volatility. And the Gulf War, all right, return 11.7%, and the risk level slightly increased. And this goes down to other equities and other assets. So what is this called? What this is called the war puzzle, all right? You know, there's a terminology of war puzzle. So it's puzzling. It's puzzling about why is it that when a war is taking place, the return is higher and the risk is adjusted downwards. All right, point number one. This analysis is on a prerequisite. The prerequisite is this is not unexpected. It is something that is expected maybe for a couple of months, like what we have seen in the current situation. The Russia and the Ukraine is not unexpected. You know, many people, many analysts, fund managers, people on the street has been speaking about it. The media has been reporting it for months. All right, so it is not unexpected. So the moment, all right, the war took place, you know what happened? War puzzle took place. It's puzzling. You know, people start, you know, getting into the stocks after the first couple of days, and it shows good returns and you know, volatility at the beginning, at the first phase period, it may be high, but the moment you go into the second phase, maybe 2 weeks after that, you will see risk level came off. All right, why is it so? The only explanation is the humankind has been conditioned, and the economy theory has taught us that every time, whenever a war is over, destruction is over, you know, something that is really bad is over, what we will see ahead of us will be a strong GDP growth, a strong economy picked up. And that's why people invest ahead of the expectation of economy upturn. All right, so generally a war don't last, and that's why capital market struck off war impact. So, you know, the other thing is about interest rate. I had said many times that I expect the interest rate this time is not going to drag the market, but because we have been expecting interest rate adjustment upwards in US, because there are so much liquidity, especially if you look at M2 in US, the money supply, it is ample. The liquidity is just incredible. All right. If I can, you know, use a description, you'll be from the ground all the way through the roof, you know, in terms of the indications about how much liquidity they have. So I anticipated that when the Federal Reserve announced interest rate adjustment within expectation, people will cheer for it because it is an indication of normalizations, and it is a reflection of the policy maker be very comfortable that we are getting out from the coronavirus crisis. The reopening is real. The data is telling the policy makers that unemployment rate has came down. You know, things are getting better. people are consuming, and that's why, you know, you notice the last couple of weeks, things turns better. And after the interest rate adjustment, I think for the first few hours, market reacted negatively, but right after that, you know, it is a rally. It is a rally in the market, you know. So if you look at the screen, if you are fearful towards interest rate because you think interest rate will kill the businesses and the consumers, you may not be quite right. Because if you look at 83 onwards to all the way to 2015, you know, interest rate adjustment upwards. If you look at the next 3 months, next 6 months, and the next 12 months, normally performance are in good positive numbers. All right, so these are some of the world events, and you see a lot of 2008. That is because of global financial crisis, subprime. If you can remember, Lehman Brothers, if you can remember, that was 2008. And then you see 1997, 1998, that was the Asian financial crisis. Many banks in Malaysia collapsed, all right, didn't have the liquidity. And the forced merger and acquisitions took place at that time. Many properties were being auctioned during that time. So, you know, I remember I was a lot younger, you know, but I was working, but a lot younger. And I remember businessmen telling me, say, Z, you know what, this is different. You know, this crisis, you know, is taking lives away. People are committing suicide. People are not able to see light at the end of tunnel. And, you know, this is different. You know, the long-lasting impact is going to affect everybody in the world. That's what they say. In fact, in all economy crises or black swan, somehow people were all saying the same thing to me, because the medias, you know, the medias actually condition them to speak as such. Because during that time, you know, whatever is being reported will be, oh no, the bank didn't do well, the industry didn't do well, the economy didn't do well, you know, all kind of negative news. And that's why people will always say to me a famous phrase, and that is, Z, you know what, this is different this time. It's the end of the world. You know, it looks like the end of the world. All right, but however, you know, we have gone through that. Every time when this happens, it recovers, the market recovers. Not only it recovers, it went all the way up to new high. All right. So there are many world events, and every time it looks the same. There were .coms, there was SARS, and in Malaysia, all right, the investment market, the business that I'm in, the unit trust industry, over the last 10 years, it has exponential growth, 137%. So during the last 10 years, you know, I'm not sure whether you can remember, but there were a lot of events such as Enron, US-China trade war. You know, there are many of it, but, you know, the industry continue to grow, because in every crisis, what we have experienced is, you know, even though they are black swans, you know, everything went down together, but there are always exceptions. There are always sectors and industry that did well. You know, for example, during the last pandemic, what we have learned is the accelerations of digitalization. So what did well are, you know, online trading, e-commerce, logistic, warehouse, courier company, and even REITs, the real estate, investment trust. So those are things that have done well over the last 2 years to start with. And one of the most interesting topic that I had over the last 3 weeks or so, a lot of investors are asking me, shall I cash out from the market because, of the war? Typically, I will ask my investors who ask me the question, or public who ask me the questions about, so what are you going to do if you cash out and redeem from the market? Are you going to put it in FD that earns about 2%, and you will take 36 years to double up your capital? 36 years. If you start working at the age of 24 and you retire at the age of 60, you make a lot of money in between. However, during that time, if your interest rate is at only 2%, the age 24 to age 60 will be the exact time that you double your FD. So that is quite pathetic. Your fixed deposit is not working as hard as we do in the industry. So, bear in mind that there are external factors like rising cost of living, the loans, the children's education funds, medical costs are increasing, healthcare are a lot more important. All right, so this is going to impact your retirement life, your retirement living, your retirement spending. So if you go back to the 2%, it is not going to do you any good. So you got to take some good opportunity. We don't like war at all. People in Malaysia or outside Malaysia, we always pray for peace. All right, but when a war and a crisis took place, don't let opportunity go to waste. All right, because market will tank and market will rebound quickly. The most recent example will be year 2020 and year 2021. What you have seen is the COVID, all right, and year 2021, the healthcare sector, the reopening sector, these are all real. All right, so let me introduce myself a little bit. So, I've been around over the last 20 over years, serving myself mostly in the capital market. And I purposely want to draw this chart to tell you that, looking back here in 1997, 1998, sorry, I couldn't see my cursor. All right, here. All right, this was the Asian financial crisis. I went through that. And as I said, there was a time that people say it's the end of the world, right? But if you look at it now, even though the KLCI index was at about 100 over points, 200 points, as low as that, people are all very fearful. But if you look at this on your screen right now, it looks like a small bumpy equity market performance. Likewise, if you go to 2008 here, all right, that was the global financial crisis. I remember as a working class, people were retrenched, jobless, no increment, salary adjustment downwards, for example, no bonus. People were so fearful. However, government bailout, government put in a lot of stimulus package, world policymakers work together. And, from here, you can see the market continue to pick up even stronger. And we have experienced many other volatility and world events. But this is where we are today, even though we are not at a peak, but, we have came from a long way. So, the last 20 years has given me some instinct, the instinct of, it looks the same this time, that the market is going into the new cycle, that the market is going to create a lot of opportunities for the investors. All right, number one, global resources. What is global resources all about? In our fund, our global resources is investing into global equity, and 1/3 of the equities and the stock markets and the stocks is about oil and energy sector. 1/3 will be into world materials, and 1/3 will be in precious metal, mainly gold, silver, you name it. All right, why global resources? It is very well diversified because you are going into energy, giving you multiple opportunities, be it explorations or productions or refining or marketing and transportation. These are needed. In fact, if you look at the war right now, it is very interesting that when the Western world trying to sanction Russia, they find it very hard to sanction the energy sector, be it petrol, be it gas or natural gas. So that is a daily necessity. Number two, gold. Gold is always a good hedge, especially in wartime. All right, it's always a good hedge. Number three, materials. Any kind of materials are being used for innovations. For example, battery. For example, chip makers. For example, your handphones, your high technology stuff. They all requires certain materials to make it up. And not only that, materials is the key items for infrastructure. All right, as US or China or the rest of the world say, we are going to rebuild our infrastructure, this will do well. All right, so our global resources fund for this year has done 20% because of all the factors almost happening at one go. First, you have inflation pressure, high oil price, that is energy. Then you have a war taking place, that is good for gold. And then innovation taking place. For example, electrical vehicle, you need the battery and certain materials are required. Handphones, 5G and 6G. So you need all of these things. And that's why all of these things over the last couple of months are darlings to many investors. So we are fairly unique because we are large cap buyers. We have got good experience, good track record, and we don't buy small companies. We buy more of the large cap. And you are very well diversified into gas, oil, coffee, sugar, and related industry. We also go into energy, hydrocarbon, precious metals, base metals, fertilizers, forest products, and chemicals. And Manulife, as I said just now, we have more than 100 years of experience. So in managing this fund, global resources, materials, oil, and energy and gold, more than 30 years of experience by our fund managers. So let's look at this. But here I want to give some words of cautious. All right. So just listen very carefully about this. As gold price fetch higher now and energy price fetch very high now, I think there are more downside than upside. So as an investor, what I personally am doing now, and I don't mind sharing it with you, is I am actually taking out for the time being. I'm cashing out for the time being because I think it has fetched certain highs. And I expect this high to come down, to retreat a little bit, and then I have a better opportunity to buy again before the next uncertainty, because the COVID is coming back. If you can see from the Europe or the China or the US, and the war is lasting, and what is after all these events could be a stagflation. So stagnant economy growth and high inflation. So there will be a second chance. There will be a second chance that things, gold price get expensive again, oil price get expensive again. So now I think it will be good to get at least the profits out, keep your principal, or get a little bit more out and wait for the next opportunity. But bear in mind that if you are doing this, you are in many ways timing the market. You are not staying on track for long-term investment goal. But I want to tell you honestly tonight, that is what I'm doing, because that is what I expect the commodities will be heading to. All right. And oil price, like for example, oil price, it fetch all-time high or the recent high here, all right, the peak, and it came down. All right. If I show you another half an hour analysis, I'll be able to tell you that people were concerned about the supply coming out from Russia in terms of oil exports. But if I analyze one by one with you, speaking about the oil reserve in the OPEC country, Iran was being sanctioned, but Iran has got a lot of capacity for oil productions. Even US at very expensive oil price. Not to forget, in US, the shale oil can come into production. So even though it will take the longer time to have that being produced, but that is on the card. All right. So, it has came down, and I expect it to come down slightly further and hovering at about 80, 90. And let's see what City Research is saying. So City Research is saying, the oil price, whichever that you want to look at, all right, Brent or WTI, let's say we are here, all right, we are here or here. First quarter 2022, second quarter 2022. So it will go down, it will go down, all right, it will go down, it will go down, and then the average will be something like 90. All right. But if there is a super bull cycle in this commodity, all right, it will go very high. All right. And that's where you make extra money, and there is opportunity within the global resources space, or even a bull run. All right. This is a super bull. This is a bull run or a base case. That is good enough for you to expect, the oil price coming down now, but not permanent. There will be a pickup again. But it's always difficult to do this, it's always difficult. Let me illustrate to you why is it always difficult. Because at peak, I'm not sure whether how many of you are buying at peak, but if you are buying at peak, the moment it comes down here, you will not buy because and you may not sell, and then you are waiting, you wait and see, you want to wait for the bottom, and the moment it turns around, that's it, you will pick up very fast and you miss the timing. This is exactly what happened in Hong Kong. The other day when in Hong Kong, the market dropped by about 20% in 2 days. And I was giving a talk like that, and I was telling people that you were picked up because at that point, you are talking about maybe a 6 years low and it is almost at the point of the global financial crisis. You know what? The following day, market picked up by almost 10%, and the following day, the market picked up by another 10%, and since then, it has been a stable market. So here, if you want to time it, it's not as simple. So you may just stay on track. That could be better. All right. Next, this is just an example in US passing a lot of infrastructure bills to build infrastructure, all kind of infrastructure, be it transportations, broadband, power, water, pollutions, electrical vehicle, you name it, all kind of infrastructure. So, you need energy, you need metals, and you need commodities for it. So some of the examples that I can show you, some of the global equity in mining and also precious metal stocks. Some of these are very well known because there are not too many of these companies in the world. All right. And this is oil and gas, a very familiar name to all of us. All right. These are our Manulife fund managers in US. All right. So they operate in US. If you look at the gentleman, 32 years of experience. If you look at his colleague, 34 years of experience. They are highly qualified, highly experienced. So you can count on them to deliver performance for you. Because commodities, all right, has got many cycles. So in order to catch the cycle is not easy. And that's why commodity is never a core fund per se. Most of the investors take it as a satellite fund or a fund for diversification. Like right now, I think it is a wonderful inflation hedge because things are getting so expensive. When houses get expensive, you buy a house, you buy REIT for your inflation hedge. When things are getting more expensive, like gold, like energy, oil price, so you invest in it early to hedge the inflation's pressure. So if you look at the performance, 2021 was good, 20-odd%. 2019 was good, close to double digit. This year has been good. All right. This is, I said, 31st January. I'm sorry, but if you go all the way to right now, March, when the war is taking place, it is double-digit returns. All right. The other necessity that we all need will be the blue gold. I call this the blue gold. Just now it was, the precious metal gold, but I call this the blue gold because this is the global equities investing in the water business, the aqua business, daily necessity. So what is this all about? This is a fund that invests in the deep and diverse range of opportunities in water sectors. And water is proven to be resilient because it is used by you and me daily. We consume it, we use it. So, we need it. So it is highly resilient throughout any economy cycle. Let's look at this. All right, there are three lines since the year 2001 to quite up to date. So, we went through dot-com bubble, we went through global financial crisis and COVID-19 pandemic crisis. But what you have seen, the line on top is the performance of the S&P Global Water Index, giving you 900% return. Oh, wow, 900% return. All right. And if you are only investing into the world index, you probably get about close to more than half of your water performance. And if you are investing into a S&P 500, it is also about more than half, slightly more than half. But the keyword is half. You're only getting half. All right. The water has really outperformed in this case. So why invest in water? Let me show you a video. Enjoy it.
%70 of the Earth is covered in water. But did you know only 0.025% is freshwater accessible at the surface? Freshwater on our planet is likely to have been around since the time of the dinosaurs, and its amount has remained fairly static. However, the world's population has expanded exponentially. By 2030, demand for water is expected to exceed supply by 40%, and nearly half the human population could suffer severe water stress. Water, or as some would call it, blue gold, is a precious resource under tremendous strain. There is an increasing gap between its demand and supply, as well as rising concerns about water quality and the stability of water infrastructure due to increased urbanization and advanced living standards. Higher consumption patterns are part of this modern lifestyle, and the water footprint to produce some common goods may surprise you. Aging or poor infrastructure. In Asia alone, the estimated loss of treated water is 29 billion cubic meters annually. Greater incidence of drought and floods. Tightening regulations. These global trends are propelling long-term growth in water opportunities. $7.5 trillion is expected to be spent on water infrastructure globally, and $300 billion has been directed to address water pollution by China's Water 10 plan. The Aqua strategy aims to capture opportunities by investing in a diversity of water-related companies globally, across a deep and wide range of defensive and cyclical stocks that span geographies, sectors, and end markets. This fast-developing water sector grants us access to companies that offer stronger earnings growth than global equities. Thanks to technological advances, opportunities are expanding to include innovative solutions. The strategy benefits from the transition towards a more sustainable economy, while creating a positive environmental impact, as it is highly exposed to businesses whose revenue sources are aligned with the UN Sustainable Development Goals of providing clean water and sanitation. ESG values are incorporated throughout the investment process, making risk analysis more robust. Lastly, since 2008, the Aqua strategy has been managed by Impax Asset Management, a close partner of BNP Paribas Asset Management, who specializes in sustainable environmental investing. Invest across the rapidly growing water value chain.
All right, I think the most important thing about this video is to point out the importance of water, and to actually tell you that we are investing into the whole value chain of water business, the whole value chain. Anything that has got to do with water listed in the stock exchange worldwide, you know, it could be our holdings. So why water? Urbanizations, you know, cities are being developed, and that's why you need water. Scarcity, and that's why you need water. Technological innovation, and that's why one of the sector that you want to get into. And aging infrastructure. If you look out at some of our water infrastructure, be it the sewerage system or the longkang, you name it, you know, it requires upgrade worldwide. All right, worldwide. So what are we buying? You know, company produce home filtration system. So I'm sure you have it. You have it at your pouch. You have it at your basin. You have it in your shower room. So you know, it's a good business. Number two, you know, this is a water leakage detection system. So a lot of buildings, factories, you name it, big buildings, they will install something like this, so that when there is irregular flows of the water, you know, notifications will be sent to your handphone. all right? So you'll be able to detect water leakage. So very common, especially for condominium, for example, all right? So things like that are listed. The producers, the manufacturers are listed in the exchange, and it's a good buy because people need more and more of this because of urbanizations, water scarcity, and the technological aspect of it. So this is another example in USA. So this is used for flood control, hydroelectric power, agriculture, irrigations, and domestic water supply. So a counter for your consideration. So turning human waste into drinking water. So the keyword is desalination. All right. So as you know, Johor, in our country, Johor, we supply water to Singapore. So they go through the treatment process and make it drinkable water and sell it back to Johor. So this is the whole process before, but now there are a lot more technologies that is capable of doing this. Okay, let's look at the picture. This may not be the one in Malaysia, but we have seen quite a couple of those in Malaysia. So this is portable water container. All right, so it is also very useful, widely used. Next example, aging infrastructure. So if you look at the company, the GF, and the company IDX, so look at the pictures. What are they producing? It's all about pumps, meters, systems, cables, So these are the companies that the Manulife Global Aqua Fund will be investing into. Another stock example, American Water Works, more than 100 years, very established company. Trimble is a lot got to do with technology. So Trimble has got a technology to help agriculture, farmers, for example. It predicts the weather. It has got GPS system set up. So it will indicate when to water your plants, when not to water your plants because you have enough rains and things like that. So a company like Trimble, they are selling their solutions, they are selling their expertise towards farmers and agriculture users. So, the fund, is very US and Europe centric, and he has done very well. Look at the 5 years result, 91%, 3 years result, 73%, 1 year result, 25%. And just now, if you can remember, the last 20 years, the last 20 years or so, 800 to 900%, all right, just the water index. But it didn't do quite well for year to date because of the war, because of the fear towards the inflations and interest rate and the war. But this is the January number. If I show you the March number, it has improved a lot. So we are now going back to the drawing board of about 50 cents. So I think the best time may be over, but it's a brand new start, a brand new cycle. It is timely as the dust settle down. We are more comfortable with interest rate hike. We know how to deal with inflation. We know the war is going to be over and stock market will rally. I think don't let the global crisis go into a waste. All right. So that's my favorite phase. So, how is your formation of investment is very important. If you look at
Mr.
this,
Mr. Ng, sorry to interrupt, but we are running out of time. Perhaps you want to wrap up your presentation and then we can take some questions.
Thank you. Thank you.
Thank you.
Thank you. I get very excited tonight, but I'm wrapping up now. Okay. So if you look at this, all right, over the last 10 years or so, okay, maybe I start from here. You know, real estate did well. So do have a portfolio in REITs, gold did well, US stocks, and then real estate, non-US stock, gold, you know, and you can look at bonds, real estate. So you need to have a portfolio because in every different year, there are champions and there are losers. All right. So a diversification with advice coming from fund managers or financial planners to you would be very good. So in our case, risk versus rewards, how we will put it is you start from the safest fixed deposit, 2%, and you go into bonds and you go into REITs, all right, quite inflationary proof. And then you go into commodities like global resources and global aqua. And then you can go very high risk when the time is right. For example, US, single country, China, single country, India, single country, you can do that. So with that, I want to thank everyone for tuning in. And I think it's Q&A time, right? Thanks, Joanna.
Thank you, Mr. Ng, for the insightful presentation. Now let's take some questions from the Q&A chat box. Okay, the first question is, can the world central banks continue to print money in perpetuity without crashing like the Weimar Republic?
Okay, that's a very interesting question. Thank you for the questions, very interesting. I will answer it in one or two ways. Number one, I think the superpower house can print money to almost indefinite. For example, US dollars. Remember the helicopter money? You know, they print trillions and trillions. You know what? Because worldwide, we are using that currency. However, you know, if we use our country as an example, if we start printing money, indefinite amount of money, what will happen is you will see depreciations of ringgit in a very fast manner. And that's why in certain countries, you see big notes. You know, one of their notes could be 1 million or 2 million or 3 million. Sometimes it's not my choice. It's all because of depreciations. Because the moment you print money and people are not taking it and consume and use it, you got a big problem. Unlike US, these are international currency. People stock it up, people use it. So for a country like that, the stimulus package by printing money is workable, all right, but not for many other countries. Thanks for the questions.
Okay, and now the next question. With the limited cash flow, how to consider to top up during volatility in order not to catch the falling knife?
All right, the falling knife, thanks for the question. The falling knife is always difficult to catch. So you try not to catch a falling knife, all right? So what you do is, as the knife is falling, you are buying at, you know, a high point, a midpoint, and a low point, you know. So you buy at different intervals. So to catch a falling knife is extremely difficult, and I have not seen anyone doing it very successfully. But what you can do is, you know, just a dollar cost average, buy at different points, buy at every week, buy at every month, for example. That will help you to lower down your average cost. And with that, you know, you will escape from getting, from buying at the high side and miss the opportunity when it's bottoming. All right, because if you start buying falling knife, if you start buying at this point, and this point, all right, you'll be all right. Okay, thanks for the questions.
Okay, next question. You mentioned that Global Resources Fund have potential upside. Do you suggest to show hand on the fund or buy regularly?
Oh no, okay. The Global Resources Fund is invested in gold, energy, and materials. All right, don't show hand. It is just part of a portfolio. All right. If you show hand now, you may have a risk of losing quite a fair bit or earning quite a fair bit. But for commodities, equities, it is very sensitive because the moment, let's say the war stop and you see gold price moving down and you see gold stocks moving down. And when we settle with the energy, you will see energy prices, declining. And then you will see some of the stocks may be on the declining trend as well. The one that I'm most comfortable will be the materials because that will be required at all time. So I will suggest for a fund like this, make up 20% of your total portfolio. Just now what I say is maybe it's time to cash up a little bit and then show hand when it goes into another low. Because if you remember my oil price chart, it has already came down. All right, so you don't show hand. You want to buy the falling knife. You want to start accumulating now. It drops further, you buy a little bit more. It drops further, you buy a little bit more, because I expect there will be another oil price high because the world is still very uncertain with many, not just what we have seen, with many geopolitical tension, not to mention US-China trade war. Yeah. All right, next.
Okay. In the interest of time, we will take this one last question. Can you comment on China and India market moving forward?
Oh, China is at very low attractive valuations, be it price to book, price to earning. And if you look at China after their last 5 years business plan meeting, they came out and they say they will assure steady GDP growth. And that's why market cheer and market reacted positively. Both Hong Kong and Chinese equity, be it Shanghai, Shenzhen, A shares, or Hang Seng, or the Hong Kong China Enterprise Index, they have inched up. However, if you look at the loss started from last year to now, it has gone down by maybe 40%. And if you are buying good quality stocks at a discount of 40%, the chances of you making good returns is potentially higher. China has got good policies and good companies for you to accumulate, be it biotechnology, be it medical, be it property management services, 5G, 6G, or even electrical vehicle car components, not the car itself, but the supply chain, semiconductors. There are plenty of opportunities. Whereas for India, what we have seen is India is very resilient. You look at their GDP numbers, they top the world, they lead the world in terms of GDP growth. They have got young populations, they are developing the countries, the businesses, like what we see, not exactly the same, but it reminds me of China 10 years back. They are creating manufacturing hubs, They know how important it is. They are building the infrastructure. So China is now the second largest superpower house in terms of economy size. And I think India will soon, over the next 5 to 10 years, make it to top 5. They can easily beat countries like Germany, England, or even Japan. All right. So, keep it as your portfolio. China, India, global resources, even US, even Aqua Fund. These are all very important that you must have in your portfolio. All right, with that, I want to thank you.
Thank you, Mr. Ng. All right, we have come to the end of today's webinar. If you have further questions, feel free to send us an email at investhelp.my@fundsupermart.com. A replay of today's session will be available right after this on FSMOne Malaysia YouTube page. Once again, thank you very much, Mr. Ng, for joining us today, and thank you everyone for attending. Good night.
Good night.